picture a solar system. Right in the center, you have this massive, stable planet. It's heavy. It creates the gravity for the whole system. It's, predictable. And then orbiting around it, you have these wild, smaller moons. Some are icy, some are volcanic, some are spinning incredibly fast.
Right, they're dynamic.
They're dynamic. They're exciting. They're a little dangerous. Now, I want you to imagine that solar system is your bank account.
And that isn't just some cool sci-fi visualization. I mean, that is arguably the most robust way to build an investment portfolio.
It has a name, right?
It's called core satellite investing. And frankly, it's the only way to reconcile the two warring factions inside every investor's brain.
Which are what?
The part that wants to be responsible and retire safely, and the part that wants to bet on the next big thing.
That is exactly the mission for this deep dive. We are deconstructing the architecture of wealth. We aren't just talking about picking stocks.
No.
We're talking about designing a system that balances that boredom with excitement and, hard math with messy psychology.
Because if you don't have a system, you just have a collection of tickers and a whole lot of anxiety.
Exactly. It's about building a structure that can survive your own worst impulses. You need that stability, but you also need an outlet for the noise.
You have to have an outlet.
Now, before we get into the orbital mechanics of your money and the math behind this, a quick heads up. We are dropping a lot of heavy concepts today. If you want these kinds of insights delivered to your brain daily, without the fluff, just the actionable stuff, you need to subscribe to Money Mindset right now.
It's the daily habit that builds the long-term result. But right now, we are going deep.
We are going very deep on the mechanics.
Yeah, we have a heavy agenda today. We aren't just skimming the surface. We're dissecting the core satellite construction method, pulling directly from Vanguard Australia's research.
Okay.
We're going to settle the total return versus dividend debate with some help from the Bogleheads community.
That's a big one.
It's a huge one. And we're going to tell you the exact time to rebalance your portfolio. And spoiler alert, the calendar on your wall is wrong.
And we're going to end with the software that runs the hardware. The psychological stages of wealth identity. Because you can get the math perfectly right and still blow it if you don't understand your own head.
Which happens more often than people think. I mean, the math is the easy part. The human is the hard part.
All right, let's get into it. Section 1, the architecture, core satellite, and modern portfolio theory. So break down this solar system for me. When we say core, what are we actually buying? Because core sounds substantial, but what is it?
The core is the boring part. And I say boring as the absolute highest compliment in finance.
Right. Boring is good.
Boring makes you rich. According to the research from Vanguard Australia, the core should be the absolute bulk of your portfolio. We're talking low-cost, broadly diversified index funds, passive investments.
This is the set-it-and-forget-it money, the bedrock.
Precisely. The purpose of the core is reliability. It tracks the market. It's tax efficient because it's not trading constantly. It's not churning. It has low volatility relative to, individual picks.
It's the engine of the car.
It's the engine of the car. It's not the flashy paint job. It's the thing that actually gets you to the destination.
Okay, so if the core is the engine, let's say it's 80 or 90% of the money, what are the satellites? Why bother with them at all if the core gets you there? Why not just have a giant planet and no moons?
Because people get bored. And when people get bored, they make mistakes. The satellites are the turbocharger, or the custom rims.
I like that.
This is the active part of the portfolio. This is where you tilt the portfolio to try and generate alpha.
Which is just finance speak for outperforming the market,
And
right?
beating the market. This is where people get to scratch the itch.
Right, because let's be honest, buying an index fund is smart, but it's not exactly fun to talk about at a dinner party. I bought the entire haystack is a very short conversation.
It is a very short conversation. That's a huge part of it. The satellites allow you to explore specific sectors, like maybe you're bullish on renewable energy or AI, or simply satisfy the desire to pick winners.
So it's a psychological release valve.
It's a release valve, and Vanguard makes a really interesting point here. The old debate used to be active versus passive. You had to pick a side like it was a religion.
Oh, yeah. You were either a boglehead indexer, puritanical about fees, or you were a stock picker trying to beat the street.
But the core satellite approach says it's not active versus passive. It's active and passive. You use the satellites to take risks where you have high conviction or maybe specific ESG, environmental, social governance goals.
While the core keeps the lights on.
Exactly. The core keeps the lights on and ensures you don't lose your shirt if your bet doesn't pay off. It compartmentalizes the risk.
But this isn't just a vibe, right? It feels like we are justifying gambling by wrapping it in a strategy. Is there actual academic hardware underneath this, or is this just a way to make us feel better about buying tech stocks?
Oh, absolutely. No, this isn't just a mental accounting trick. This is grounded in modern portfolio theory, or MPT. We have to tip our hat to Harry Markowitz, who won a Nobel Prize for this stuff.
Okay, let's unpack MPT without turning this into a lecture hall, but I think people need to understand the why. I always hear about the efficient frontier. It sounds like a sci-fi show, but what is it actually measuring?
Okay, imagine a graph. On the vertical axis, you have return, how much money you make.
Easy enough.
On the horizontal axis, you have risk, how much the price bounces around, the volatility. Markowitz proved that for every level of risk you are willing to take, there is a theoretical maximum return you can get. If you plot all those points, it creates a curve.
The Markowitz bullet.
Exactly. It looks like the nose of a bullet pointed to the right. The efficient frontier is the very upper edge of that bullet. You want your portfolio to be on that line.
And if you're not on the line, if you're inside the bullet,
If you're inside the line, you're taking too much risk for too little return. You're inefficient. You're paying for stress that isn't paying you back.
and the magic trick of MPT to get to that line is the free lunch, right? That phrase always stuck with me because there is no such thing as a free lunch in economics.
Except here, that is the key insight, diversification. Markowitz proved that if you combine assets that aren't perfectly correlated, meaning they don't move up and down at exactly the same time, you reduce the overall risk of the portfolio without necessarily sacrificing returns.
Which is so counterintuitive. Usually in life, to lower risk, you have to lower your reward. If I want a safer job, I usually take less pay.
Correct. But here, the math works differently. If you hold a core that covers the whole market and satellites that move differently, the math says you get a smoother ride. The volatility cancels out to some degree.
So it's about making the whole greater than the sum of its parts.
It is. There's actually a concept called the two mutual fund theorem.
Two funds. That sounds way too simple.
It's a mathematical proof. It states that to hit any point on that efficient frontier, you really only need two things: a risk-free asset, like a treasury bill, and a risky market portfolio. You just mix them in different amounts to dial in your risk. The core satellite model is basically the practical real-world application of that theorem. The core is your broad market exposure, and the satellites allow you to tweak the risk profile to suit your personal efficient frontier.
So we've built the solar system. We have the core planet and the satellite moons. We understand the physics. But here's the problem with space.
Yeah.
Things move. Planets drift. Moons orbit. Your allocation changes.
Right.
This brings us to section 2. The maintenance.
Rebalancing, the part everyone knows they should do, but nobody wants to do it.
The standard advice I always hear is rebalance once a year, or maybe quarterly. You put a reminder in your calendar for January 1st. You log in, you sell what went up, you buy what went down, and you fix your percentages.
And that advice is, well, it's fine, it's better than nothing, and imposes some discipline.
But
sources from the Portfolio Construction Forum, specifically looking at research by Kitzes and Dariani, suggest that time-based rebalancing is arbitrary.
because the market doesn't own a calendar.
Exactly. A bull market doesn't care that it's Tuesday. If you rebalance just because it's January, you might be cutting a winner too early, right when it's taking off.
Or selling a loser before it's hit bottom.
Or selling a loser right at the bottom. You are imposing a human construct on a chaotic system.
So what's the better way? If the calendar's out, what's the trigger?
The look often, trade rarely approach, it uses something called tolerance bands.
Okay, define a tolerance band for me. It sounds like something from an electric fence.
It's kind of like that. It's a threshold, a boundary line. Let's say your target allocation for stocks is 50%. You don't sell if it hits 51%.
That's just noise.
That's just noise. That's a Tuesday. You wait until it hits a specific band or boundary before you act.
But here is where it gets really interesting, a little tricky mathematically. There's a debate between absolute bands and relative bands. And getting this wrong seems like it could mess up the whole core satellite structure, specifically the satellites.
Yes. This is a crucial nuance. An absolute band is simple. It's saying plus or minus 5%. So if your target is 50%, you rebalance at 45 or 55%. That works okay for big chunks of your portfolio, like your core.
But what if you have a small satellite position?
Yeah.
Let's say I have a high conviction bet on gold or a specific biotech fund, and it's, say, 10% of my portfolio.
Right. If you use an absolute 5% ban on a 10% position, think about the math. That asset has to go up to 15% before you sell.
That's a 50% increase in value.
A 50% increase, or it has to drop to 5%, a 50% crash before you buy.
That's way too wide. You'd almost never rebalance. You'd miss all the volatility you're trying to capture. You're effectively asleep at the wheel for that asset.
You're totally asleep. So for smaller positions, your satellites, you need relative bands.
Which is where the Dariani study comes in. What's the magic number?
The study suggests a 20% relative threshold is optimal.
Let's run the math on that 10% goal position again, using the relative band.
Yeah.
This is important, so listen closely.
Okay. Your target is 10%. A 20% relative move is 2%, because 20% of 10 is 2.
Okay, I'm with you.
So your bands are at 8% on the downside and 12% on the upside.
That makes so much more sense. So if my gold position jumps from 10% to 12.1%, I sell. If it drops to 7.9%, I buy.
Exactly. And let's apply it to the core. If your core stock position is 50%, 20% of that is 10%. So your bands are 40 and 60. The band scales with the size of the asset.
Why is this better than the calendar method? Beyond just the logic of its scaling, what's the secret sauce?
It captures momentum. This is the secret sauce of tolerance bands. It lets winners run just enough to squeeze out that extra return, what we call the momentum factor, but the math forces you to cut them off before they likely revert to the mean.
And on the flip side,
And conversely, it forces you to buy low when something crashes, but only after it has crashed significantly enough to matter. It avoids all those tiny noise trades that just rack up transaction costs.
it removes the emotion.
Completely. It removes the should I trade anxiety. You don't make a decision. The tolerance band makes the decision for you. You just execute. It turns you into an algorithm.
I love that. Look, often, trade rarely. It sounds like Zen koan for day traders. Okay, let's move to section 3. We built the portfolio. We know when to fix it. Now we need to keep the government's hands off it. Tax efficiency.
This is where we need to distinguish between asset allocation and asset location, two very different things.
I feel like most people treat these as the same thing, or they just ignore location entirely and dump everything into the same bucket.
They do, but they're totally different levers. Asset allocation is the mix of stocks and bonds, the recipe. Asset location is where you put the ingredients, the fridge, or the pantry. We're drawing on insights from the TIAA Institute here.
The basic rule of thumb seems to be keep your friends close and your taxes lower.
That's one way to put it. The rule is put your tax-inefficient assets in your tax-advantaged accounts.
Okay, give me the apples to oranges breakdown. What goes where?
Okay, let's start with bonds or high-turnover active funds. They pay interest. That interest is taxed at ordinary income rates. For high earners, that can be 37% federal plus state tax. It's painful. It drags on your return every single year.
It's like getting a paycheck and losing half of it immediately.
Exactly. So you want to shield that. You put bonds in your IRA or 401k. The tax shelter protects that high tax income.
And stocks go in the taxable account, my regular brokerage account.
Generally, yes. Especially your core index funds. Why? Two big reasons. One, capital gains taxes are lower, usually 15 or 20%, so you'd rather pay that rate than the income rate.
Makes sense.
Two, and this is key, you control when you pay the tax.
Because you only pay when you sell.
Right. That is tax deferral. You can hold an index fund for 30 years and pay zero tax until the day you sell. You are compounding money that would have otherwise gone to the IRS.
And you can do that magic thing called tax loss harvesting.
Correct. If a stock in your taxable account tanks, you sell it, book the loss to lower your tax bill and buy something similar. You can't do that in an IRA. The IRS doesn't care about losses in an IRA. You get no benefit from them.
But wait, there's a huge gotcha here that the TIAA Institute points out. It's about how we calculate our net worth. And frankly, this part scared me a little when I read it because it means I'm poorer than I thought.
This is the after-tax reality check, and it blows people's minds. Let's say you have $100,000 in a traditional IRA and $100,000 in a Roth IRA. Do you have $200,000?
On paper, yes. My dashboard says 200K. I feel like I have 200K.
In reality, no, you absolutely do not. The Roth IRA is yours. That 100,000 is all spending money because you already paid taxes on it.
Uh-huh.
But the traditional IRA, you haven't paid taxes on that yet. The government essentially has a mortgage on that money.
A mortgage. That's a terrifying way to put it.
It's accurate. If your tax rate in retirement is, say, 25%, you only actually own $75,000 of that account. The government owns the other $25,000. It's just sitting in your account, mingling with your money, but it's not yours.
So if you are trying to do a 60-40 split of stocks and bonds, and you ignore this,
Your math is wrong. You are likely overweighting the assets in your tax-deferred accounts because you're counting the government share as your own. You think you have more bonds than you actually do, or more stocks, depending on where they are located.
that is a massive blind spot. So the actionable takeaway here isn't just put things in the right place, it's do the right math.
Yes, you need to convert everything to after-tax dollars before you run your percentages. It's a bit more math up front. You have to estimate your future tax rate, but it gives you the only number that actually matters, purchasing power. Otherwise, your asset allocation is a lie.
Okay, speaking of purchasing power, let's step into the ring for the heavyweight fight of the investing world. Section 4, total return versus income investing.
This is a debate that gets heated. We're pulling this from a great discussion on Bogleheads Live with Colleen Giaconetti. This hits a very emotional chord for people.
Here is the scenario. You have a retiree. Let's call him Bob. Bob says, I worked hard for this nest egg. I want to live off the dividends. I never want to touch the principal. It sounds responsible. It sounds safe. Don't eat the seed corn.
It sounds intuitive. It feels very prudent. Live off the interest. But from a mathematical and risk perspective, it is arguably a flaw. We call it the income approach.
Why is it flawed? Who doesn't like getting checks in the mail? It feels like free money. If I get a dividend, I don't have to sell anything.
The problem is yield. In a world where yields are average or low, to get enough cash flow, say 4 or 5% to live on, you have to distort your portfolio. You have to go hunting for high dividends.
You end up buying a bunch of utilities, consumer staples, maybe some junk bonds.
And you ignore tech. You ignore growth. You ignore a company like Google or Amazon because they don't pay a dividend. This creates a value trap.
A value trap.
Yeah, you end up less diversified and arguably taking on more risk because you are concentrated in just a few sectors that happen to pay cash. You are missing out on the biggest engines of the economy just because they don't mail you a check.
And the tax man is waiting there too. We just talked about tax efficiency.
Yeah.
Dividends seem inefficient.
That's the tax drag. Dividends are forced taxable events. If Apple pays a dividend, you get the cash and you owe the tax. It doesn't matter if you needed the money or not. It doesn't matter if you're in a high tax bracket that year.
Yet you have no control.
You have no control. The company decides when you get paid, not you.
So what is the alternative? If income investing is the old way, what's the new way?
The total return approach.
Total return.
Total return says, ignore the yield. Focus on the total growth of the pot. If the portfolio goes up 8%, it doesn't matter if 2% came from dividends and 6% came from price appreciation. It's all 8%.
But Bob the retiree asks, how do I buy groceries with price appreciation? I can't eat a stock chart.
You sell shares. You create a homemade dividend.
And this is where people freak out. I'm selling my shares. I'm running out of money. I have fewer shares today than I did yesterday.
I know.
It feels like you're dismantling the house to burn the wood for heat.
That is the psychological hurdle. People have a significant aversion to spending from principal. But think about the math. Imagine a pizza.
I'm listening. I like pizza.
The income investor waits for the pizza to magically grow a new pepperoni slice and eats that. The total return investor sees the whole pizza getting bigger. If the pizza grows by 10% and you cut off a 4% slice to eat, you still have more pizza than you started with.
Even though you have less pizza by volume or fewer shares, the value remains.
Exactly. If you sell 4% of your shares, but the shares went up 4%, your account value is the same. You haven't lost wealth. You've just converted paper wealth into cash.
And the benefits of doing it this way. You get more control.
Way more control. First, you stay perfectly diversified. You own the whole market, not just the dividend payers. Second, tax control. When you create a homemade dividend, you choose which shares to sell. You can sell the ones with the least gain or even a loss to minimize taxes. You are in the driver's seat, not the corporate board of directors.
It seems like the income approach is an emotional crutch. It feels safer, but it's actually leakier.
It is. It's a behavioral hack that helps some people sleep at night. But if you can get past the mental block of selling shares, total return is mathematically superior for presuming wealth. It's not even close.
We talked a lot about the math and the mechanics, the hardware of investing. But as you mentioned at the top, none of this works if the software is buggy.
Mm.
This brings us to Section 5, the human element.
The psychology of wealth identity. This is the big one.
This comes from a fascinating paper by Burgundy Asset Management called Money, Meaning, and Identity. And the core concept here hits hard. Wealth isn't just a number in a spreadsheet, it is an identity.
And when that number changes, whether it's sudden, like a lottery win, or an inheritance, or gradual, like a career taking off, it shocks the system. It challenges who you think you are.
Burgundy outlines 4 stages of wealth identity. I want to walk through these because I think a lot of our listeners will recognize themselves in this, maybe without even realizing it.
Absolutely. Stage 1 is the honeymoon.
It's the Wolf of Wall Street phase,
Flavor.
right? Champagne and yachts.
Ideally with less crime, but yes.
Yeah.
The primary feeling is narcissism, invulnerability. The world is my oyster. You get the money and you feel blessed. You go on spending sprees. You feel powerful. You treat everyone to dinner.
What's the trap here? Because feeling powerful sounds pretty good.
It feels like a love affair with the world. But like any honeymoon, it's not reality. It's a dopamine high. You detach from the consequences of your spending, and usually it's followed by a crash when reality sets in. You realize the money isn't infinite.
Which is stage 2, wealth acceptance. Which sounds good, but it's not.
It's a misleading name. Acceptance here actually feels terrible. The rose-colored glasses come off. This is where the guilt sets in, the shame, the paranoia.
They tell the story of Amy, a lawyer who won the lottery. This really stuck with me.
Amy is a tragic but common example of this stage. She won big, but suddenly she felt she lost her identity. She wasn't Amy the lawyer anymore. She was a walking ATM. She felt her friends were judging her. She felt like an imposter.
That paranoia, do they like me or my money? That has to be incredibly isolating.
It's incredibly isolating. She actually wanted to give the money back. She felt the money had stolen her self-worth. This is where people self-sabotage. They make bad investments or give money away foolishly just to relieve the pressure of having it.
So if you're stuck in this guilt-shame spiral, how do you get out? How do you stop hating your own success?
You move to stage 3, identity consolidation. This is the pivot. You stop seeing money as all good, which is the honeymoon, or all bad, which is acceptance. You find the middle ground. You say, I am not my money, but I have money.
This is where you have to sort through your baggage, your money stories from childhood.
Exactly. We all have money scripts. Maybe your grandmother saved breadcrumbs during the Depression and now you feel guilty buying a coffee. Or maybe your parents fought about money, so you think money equals conflict. In this stage, you decide which of those values serve you now and which ones you need to let go of. You integrate the wealth into your life story rather than letting it rewrite the story for you.
And finally, stage 4, achieving balance or stewardship.
This is the goal. Money becomes a tool, not a master. In Amy's case, she didn't quit law. She didn't give the money back. She used the money to start a private practice for underserved women.
She aligned the money with her purpose.
That's the key. When the money serves a purpose higher than just consumption, the guilt evaporates. You become a steward. You're holding the wealth, growing it, and using it for something that matters to you.
It's funny. We started with satellites and tolerance spans, and we ended up with therapy.
It's all connected. The math of the core satellite strategy only works if the person at the center of the orbit is stable. If you are stuck in the honeymoon phase, you'll gamble with your satellites and blow them up.
Right.
If you're stuck in acceptance and guilt, you'll be too afraid to invest your core and you'll lose to inflation.
So to recap the system we've built today, we have the hardware, the core satellite architecture, using MPT to balance risk and reward. We have the maintenance, relative tolerance bands for rebalancing to capture momentum. We have the efficiency, asset location to lower taxes and handle the government's mortgage on your pre-tax accounts.
And we have the software, the total return mindset over the income illusion, and the journey through wealth identity.
A complete system.
It really is. It takes the emotion out of the mechanics and puts the emotion where it belongs in the purpose.
Here's my final thought for you to chew on. Look at those wealth identity stages. Even if you aren't a lottery winner, maybe you just got a raise. Maybe you just hit a savings milestone. Where are you? Are you in the honeymoon phase, thinking you're invincible? Or are you in the acceptance phase, realizing that your savings plan requires sacrifice and feeling resentful about it?
Identifying the stage you are in is the first step to moving to the next one. Don't let your portfolio outgrow your personality. The math only works if the person is stable.
Keep digging deep. We'll see you next time.
Take care.